My name is James Downing, and I'm a CPA, and I've been working with Charles Najoya over the last several months. And I would like to introduce to you Charles Najoya, CPA.
Thank you, James. Thank you. It's always a pleasure to talk to you. And today, we're going to be talking about a few things that will edify the public. And let's get rolling.
Charles, I know that there's confusion around filing status.
Yes.
What have you seen around that issue?
So, thank you so much for that question, James. Filing, the reason I talk about filing status as being an issue is when I look around my community, the most of people I work with, filing status is it's the beginning of a tax return. And when you think about tax return, you're thinking about the most important document from a tax perspective that you have. And it's also the most important document that you have in order to access capital. So you have to do it right. This issue of filing status, in most cases, you see people, filing status have different categories. You have married filing joint, you have married filing separate, you have head of household, and then you have single. The problem we see here is that you see you see quite a few couples who are married living together, and instead of filing married filing joint or married filing separate, they tend to file as either single or head of household. Why? Because they get more benefits from that. And when you file as head of household, your spouse files as head of household with maybe 2 children, the other one files as head of household with 2 children. That is called fraud. So this is an area that I see a lot when I do tax resolution. So people have to take filing statuses very seriously when it comes to filing.
Charles, could you tell me a little bit more about the married filing separately filing status?
Okay. So married filing separate is the worst filing status when you look at the filing status order. The best filing status is always married filing joint. Then you come down, you have qualified widower is almost, you get the same benefits as married filing joint. And then you have head of household, you have single, then you have married filing separate. The problem with married filing separate, the thing with filing separate is that it is the only alternative that spouses have when they are married and living together. The only alternative you have apart from married filing joint is married filing separately. And when you file married filing separate, you're going to lose a lot of your tax credits and many deductions. So it's one of the worst filing statuses. People, in most cases, when you see people say they are living together, very few of them use that filing status because whoever is preparing their tax return will not like that because it doesn't give them some of the benefits that they're trying to accrue. But if you don't file that, if you're married, you only have those 2 statuses, married filing joint or married filing separate. The only time you can get something else is if you were within the last 6 months of the year, you stayed apart from one another for at least 6 months and 1 day. Then you can file as head of household. That's what I can say for that.
Charles, what have you seen as far as the biggest issues and predicaments that people get themselves into related to the IRS?
That's a big kind of worm right there. You know, the IRS, I've been doing tax resolution for quite a while. And one of the areas you see people getting issues with, and I will say this, is they just don't file correctly. People don't file returns correctly. The IRS has a set of rules that you must follow. And many a times, this thing about income, you file your taxes on worldwide income. worldwide income, wherever you make the income, as long as you're a resident of the United States or you are a citizen of the United States, you file taxes in the United States on your worldwide income. What happens is that when people start making a lot of money, they tend not to file their taxes. And especially when they start businesses, most people, when you're a W-2 payer, W-2 worker, you don't have a lot of problems because your taxes are withheld before you even get your money. But when they get from that and then they start a business and the business starts making money, most people don't realize that you have to pay your taxes as you go. And when you get to the time when you have to file taxes and then you realize you have this big tax bill to pay, most people just overlook it and then they keep going. Before you know it, the IRS might even file the tax return for you. And if they do, you're in trouble because they don't have any deductions, right? You understand what I'm talking about. The other thing that people get into is that even when they file returns that they are owing money to the IRS or to their state departments of revenue, when they don't pay their tax liability and they get these first notices that are coming from the IRS, they ignore it. And the IRS doesn't like to be ignored. This is called ghosting. The IRS doesn't want to be ghosted. You don't want to ghost the IRS. And before you know it, you get liens, you get garnishments, you get all of this because you ghosted the IRS. You don't want to do that.
Charles, I understood you to say that when you have income abroad,
yes,
you have to report it.
Absolutely.
If you've paid taxes to those foreign governments, does the IRS allow you?
Absolutely. Great question. So for those of us who are international workers, right? If you work abroad for a certain period of time and you made money in that country, there's something that is called, you have two options. If you paid any tax to a foreign entity, you have something that is called foreign tax credit that you get on that tax return. So you prepare your taxes on the basis of the U.S. tax filing system, and then you calculate whatever your tax liability is, and then the IRS gives you that credit, which is related to whatever you've paid abroad to be able to reduce your tax liability. So you don't get to pay more than you're supposed to pay. That's number one. There's also something that is called foreign earned income exemption, right? So when you work abroad, because if you meet a certain number of days of working abroad, you are able to get what they call foreign earned income exemption. So the income that you earn abroad, you can exempt it from taxes. But mind you, and this is very important, especially to those who are like, they go abroad and they make faraminous amounts of money. There are people who go abroad, they do athletes, some athletes, they go and then maybe they're fighting abroad, they do this and they get millions of dollars, which are paid to them as a result of that particular thing. You get something, that exemption is only limited to about, I think it's $100,800 as of 2023. So that's the only amount that you can exempt from taxation. If you made $1 million, you're practically going to tax the whole $1 million in the United States because the foreign earned income exemption is so small compared to that. And the second thing is, if you are in a country and then if you paid any taxes in that country, you're going to take the tax credit on that.
Charles, why is it important to use a tax professional to help you with your taxes?
That's a great question. And before I answer that question, I would like to give you the difference between a CPA, who is a tax accountant, and a tax strategist or a tax professional. A CPA, in most cases, you and I understand that, we work on the basis of historic information, right? So we are basically helping the client to be able to pay taxes. So we're determining how much, based on what you've done over the whole year, this is what you are supposed to pay in taxes. That is what a CPA does. What a tax strategist does, who is basically that tax professional that you need to hire, is it helps you, and especially, I say this, especially for those of you who are higher income people, you always want to work with a tax strategist. What the strategist does is he's basically working with you throughout the year. And this is not just one person, it's a team that is working with you throughout the year. They're helping you avoid taxes. So instead of helping you pay taxes to the IRS, the strategist is that guy who spends his time reading the tax code, understanding the loopholes in the tax code, understanding all the tax credit, the benefits, the deductions, all the type of tax mitigation items that you can use to avoid taxes. So he's that guy who's going to help you really avoid paying all the taxes that you otherwise would have been giving to the IRS. That's the main difference.
Why is it important to have a trust?
Great question. So when we talk about trust, and I see this in the community where we live, trusts are being looked upon as, when you talk about trust, most people think it's for rich people. And I'm going to bust your bubble right now. So a trust is a document from a legal foundation of your estate is a trust. So the foundation from a legal standpoint for any taxpayer, the foundation of your estate from a legal standpoint is a revocable living trust. There are different types of trusts, but what I'm talking about here is that trust that every person I've talked to who is in the top 3% of those people who pay zero in taxes, they own and which they run with, is called a revocable living trust. And a revocable living trust is basically an element, a document that gives you, it's an entity on its own. It's an element that you create on its own that can own assets, and it can also transfer those assets. Okay? And when you have a revocable living trust, it's revocable because you can revoke it while you're alive. You can change it while you're alive. When you have it, you have three sets. You have the owner, which is you. You have the trustee, which could be you or your spouse when you're alive. And then you have the beneficiary. Generally, people need trusts because trust will give you privacy. Remember, I told you that whenever you start making money in America, what happens? Everybody wants to sue you. So with a trust, revocable living trust, you're able to have privacy. You are able to transfer wealth from one generation to the other, in most cases tax-free. And then another big thing is that the trust will will avoid you something called probate. Probate is one of the biggest kind of worms in the community today, because when you have a will, you basically have to go through a probate court for them to approve that will. And if you have some crazy people in your lineage, they could contest that thing for years, and all the money that you have in the estate will be used to pay lawyers and things like that. You don't want to go through that. That's why a trust becomes that most important vehicle to really transfer wealth, to really protect wealth, and it also gives you what? It avoids you that probate where you're going to throw your money away.
Charles, you help people, but is there a threshold that where you can help people, or what is the threshold, and what type of people do you help?
Excellent question. So there are many ways to which I help people. One of the most important ways is I sensitize people. I talk in conferences. I speak to people in churches. I speak to people in my community. I tell them the importance of structuring your estate. I tell them the importance of understanding how America works. I tell them the importance of building proper structures to protect your assets, to basically mitigate taxes and to build wealth. When I talk to people there is no limit, because that is the first stage of what I give to the community. I talk to them, I sensitize them. The second stage is I tell people what are the different levels of wealth building. So when you're talking about wealth building, there is the first stage is always income generation. I can't start helping somebody who doesn't even have income, right? Because basically income is going to help you build wealth. So I help you structure. There's something we call the trifecta, which basically helps you understand how you have to structure your income from what you call operations to what you call assets, and how you structure the foundations and things like that. But I tell you that the first thing you need to do is to generate income generation. That's the first stage. The second stage of your wealth building process is what you call asset accumulation. When people start accumulating assets, then that is when I want to talk to them. Because that's when the IRS starts looking at you at taking all your money in the form of taxes. And you have to structure properly in order to accumulate that asset. Once you start accumulating assets, I tell people all the time that buying your first home is one of the most important things you want to think about. If you are somebody who is young and you're starting your life and you want to build assets, most people think that your first home is your biggest asset. It is actually your biggest asset, but it's also your biggest liability. Because when you buy your home, it takes a lot of cash flow out of you. Anything that is taking cash out, right? Anything that's taking money away is a problem. Mm-hmm. So I tell young people at times that when you want to buy that first home, think about it as if you could basically have a conjunction of, a rental property and a personal home, that is a great combination. I tell people if you can buy a multi-family home for yourself as a beginner, for that same amount of money, there are so many multi-family homes here where you have one part of the home, you're owning the home as your home, and then the other part is given as rental. What does that do? The reason I say that is because you're getting rentals, it's helping you pay the mortgage, and then it reduces that impact of you just sending money out when you have a property. So those are some of the things I tell people. So income generation, asset accumulation, I start helping you. And that's where I start helping you in terms of buying your first property, how you want to structure, how you want to get access to asset protection and things like that. That's where I am.
Charles, I've heard you mention Dream Blueprint.
Yes.
Could you tell me a little bit more about what you mean by Dream Blueprint?
I enjoy. So the Dream Blueprint is a program that I developed based on years of experience from PwC, PricewaterhouseCoopers, to my years, the different programs that I have been investing in my quest to understanding how this country works. So the Dream Blueprint is basically a program that allows you to build wealth and transfer that wealth from one generation to the other tax-free. That's the summary of it. So within the Dream Blueprint, I tell people that you too can do what the wealthy are doing. You too can run away from being in that rat race of the middle class and be part of that top 1 or 3% who pay 0% in taxes. You too can basically, that program helps you to, number one, protect your assets, and it gives you privacy around your assets. Number two, it gives you access to all the tax mitigation strategies that are out there, depending on your circumstance. Number three, it gives you the ability to accumulate assets through the use of other people's money while also avoiding taxes. So basically, it is that thing that gives you the single thing that the top 3%, the wealthy, the best of the best in America, they have, that otherwise you will not be able to have access to. That blueprint gives you access to that.
What does the American dream mean to you?
Great question. The American dream. And I'll answer this question like a true African who moved to America a few years back. 11 years ago, I moved to America. And when I moved here with my family, that was the time I really actually moved here. I've been coming here and working here and doing a lot of stuff before that. But when I moved here, the reason I moved here is because I had worked extensively in the UK, in Europe, in France, and in Africa. And when I moved here, when I came here the first time, that was in 2003. That was the first time I came to the United States. I came here on a project from PwC UK. We came on a project in Oklahoma on an oil farm there. And what I understood about this country is that the system was completely different. One thing that I was amazed with was I could get a driver's license in America like this. When I spent a year in the United Kingdom and I couldn't even get a driver's license. Mm-hmm. So just access, and the driver's license is, people take it for a joke. This is the most important thing you want to have in America, in any developed country anyway, because it allows you mobility. If you cannot be mobile, you cannot do anything in these our markets. So I already love the fact that America was able to give access to people to come and live here for free. The second thing I realized is that when most people immigrate out of Africa, where I am originally from, to Europe, their intent is always to go back to Africa. They come to Europe, they work their money, they go back to Africa, because the welcome in Europe is not as much as the amount of, and then what you get in America. When people move out of Africa to America, they come here to stay. They buy their first home, they buy the second home, they buy property, they're acquiring assets, because there's a welcome attitude in this country. That's why we call the land of the free. That's why we call it dreamland. The only thing that I realized quickly is that if you don't understand how this country works, when you have finished acquiring all those things, you get into a circle where you are even unable to assist somebody with $100. Because when I was in Cameroon, in Africa, most people will think about European people as the people who can help you more. They can send you money. The people in America, they don't send you money. They cannot help. Why? Because they're in a system where they're constantly using the money within the country. The money doesn't go out. In Europe, they're working and sending the money back because they want to go back home. So how do you get out of this system where you are in a constant circle? I understood quickly that the problem was in the way the country was being run, in the way the system was being organized. And all that was found in one thing called the tax code. So the tax code kind of removes everything out of you. And then all the remaining money, the system, which is a capitalist system, continuously infuses you with debt. And then you're constantly working to pay debt. Mm-hmm. How do you get out of that? And that is what the top 1%, the top 3% is doing in America. They are now building assets. They are becoming investors. They are able to build wealth and go beyond. They are able to avoid that excess money that is being given to the IRS. They are able to avoid giving that money to the IRS and use it for themselves in building wealth. The system here in America, one thing about this system is that if you are building wealth for yourself, if you are accumulating assets for yourself, the tax code will allow you freedom not to pay taxes. It gives you that freedom to avoid paying taxes. Why? Because the system is not ready to take care of you when you retire. So the dream for me, the American dream for me, is that ability to be able to live beyond the that vicious circle of constantly working and paying my debt and becoming tax-free. That is my American dream.
Well, you've been talking about acquiring assets.
Yes.
Tell me about asset protection.
Great question. Great question. Great question. So when you talk about asset protection, that is one of the 3 pillars of the dream blueprint, asset protection. Again, when I started here, I told you that America has a way of taking everything you make from you. And because it's a system where people are so stressed at times because of the debt burden that they have, people are constantly looking for ways to get access to other people's money. Lawsuits are becoming rampant in the United States. Lawyers are making fortunes out of that. And so when you start making money, one of the things you're going to face very quickly is that many people, including your employees, they all want to sue you. So it is so important that you don't only protect your assets, but you protect them in the right way. You can protect your assets by creating corporations, by creating LLCs. You can get even COP LLCs, which is a charging order protection entity. It gives you that additional layer of protection on your assets, which gives you, with an LLC, you have inside protection. But when you have, with an LLC, you have outside protection. But when you have the COP entity, you have inside and outside protection. So not only limitation, when you talk about protecting your assets, you're trying to get all these things so that you are not being affected by creditors. They cannot take your home. They cannot take any of your assets. You're not also affected by those people who are looking to sue you. And you're not also being affected by bankruptcies, because the way you protected your assets can also protect you from bankruptcies. So that is what I call asset protection. Getting the right specialists to help you protect your assets in the right way. Protect your home, protect your money, protect your investments, protect your family, protect everything that you hold dear to you from third-party invasion.
Clarify the difference between an LLC and an S-Corp.
Great question. You're getting me right there. So, most people, and I see this because I have many of my clients tell me that, Charles, I save money with my LLC. I'm like, how do you save money with an LLC? It's like, I save money. Some tell you I will save money with my S-Corp. I'm like, I don't understand that. But the reality is this. An LLC is when you go to your Secretary of State's website to register a company, you can either register a limited liability company, which is an LLC. You can register a corporation, which could be an S-Corp or a C-Corp, depending on the size of the company. You can register all of that. What happens is that an LLC, which is a limited liability company, as it's known by the Secretary of State, is unknown to the IRS. The IRS doesn't understand, because LLCs you will have single member LLC and multi-member LLCs. A single member LLC is one where you are the single owner of that business. And the IRS, because it doesn't understand anything, if you call the IRS and say, I own an LLC, and then what is my tax status? They don't know anything. What they understand is that if you own your company alone, then you are defaulting to what they call a disregarded entity, which is a sole proprietorship. You file a Schedule C on your tax return. If you are a multi-member LLC, where you have so many other members of that LLC, you default to a partnership for the IRS. And that partnership means you're filing something called a 1065 with the different members, which is a separate tax return from what your own, you get what you call, you get how do you call that? You get a K1, which you now use for your tax return. So when you have an S-Corp is an election that you basically take when you have an LLC. You have an LLC, you can elect to file as an S-Corp with the IRS. And that election simply makes you, when you elect to file as an S-Corp, you are able to take advantage of certain tax benefits. That's the difference. The main difference between an S-Corp and an LLC is that an S-Corp could be registered from the get-go with the Secretary of State, but it could also be elected from the IRS. That's the main difference.
So if I understand you correctly,
Yes.
you make an S-Corp election by filing a form
Yes,
with the IRS.
that is right. There's a form called 2553. That form, you have to file it. Immediately you file, you create the company. You can file that form called 2553 to elect to file as an S-Corp. But you're not required to. The IRS wants you to do that from the start. But the IRS will also give you a leeway if you miss filing it at the start of it. The reason you want to file that form is because there are benefits of becoming an S-Corp. And that only depends on what stage of revenue generation you are in. So I tell people, if you're making anything over 50,000, when you create your LLC, I tell you, don't worry, you can file as an LLC. You can file as a Schedule C. But when you start making over $50,000 in net income from the business, there are benefits to filing a separate tax returns. In that case, I want you to create to basically elect with the IRS. Even if it's a late filing election, you elect with the IRS, and then you can file. You can basically go back to the beginning of the last year, of the current year, and then get an election as an S-Corp, and then you are able to take advantage of some of the benefits that will accrue to you. Mainly avoiding a certain portion of your self-employment tax. There is also one thing I wanted to say there. I tell my clients that there is a big benefits with filing separate tax return. Because most people think by getting an S-Corp, there's an administrative bottleneck around it because you have to do certain things, A, B, C, which you understand what I'm talking about. But the thing is, if your business is making losses, you don't want to put it on a Schedule C because it's only going to call for what? For audits. A Schedule C gives you 15 times more likelihood of an audit than filing a separate tax return. Why? Because the IRS doesn't see all the details of your business on a single piece of paper. Now, the only thing you get on your personal tax return is a K1. That K1 doesn't give any details, just one number. And the only way the IRS officer can get access to that separate tax return, which is filed in a separate department, is if they have reasonable cause to request for that tax return. And generally, there's no reasonable cause if they just see one number on your tax return. So basically, by filing a separate tax return, you're saving yourself a lot of hassle down the road.
Charles, what are some of the considerations surrounding employing your kids in your business?
Excellent question. I love your questions. I was telling people, that's my daughter right there. She is part of my team right here. The IRS, if you look at the tax code, it tells you clearly that one of the benefits of owning a business is having your family work for you. Most people don't understand what that means because it's deeper than that. When you have your family work for you, your wife is a member of the board of advisors of your LLC. Your children are all members of the board, or they are working in the company. Children can do anything for your business. They can clean the office. They can be your social media people. They can do all sorts of routine work. And even more, many of them, at times we underestimate some of those kids, but they are very smart. They add significant value to your business. So the advantage is we are getting into the festive season, Christmas. If you have your children, your family as member of your board of advisors on your LLC, you basically can have all your travel being written off as part of your expenses in your business. You basically can have your Christmas meal being written off as part of your business expenses. You basically can have their education, their school fees, if they're going to private school or whatever, as part of a deduction in the business. But that is not a forgiven conclusion.